Welcome back to Alpha Recap, your weekly market rundown from stockalpha.ai. We recorded this after the market close on June 22nd, 2026. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everybody! So excited to dig into this week. AI was basically the headline everywhere, right? It felt like every company we cover mentioned AI this week.
Exactly. The research slate this week had one dominant thread: AI momentum meeting a valuation crossroads. Analysts saw AI as driving bookings and product demand, but they also highlighted a stark split in valuations across the market.
Two-speed market. Sounds dramatic. I love it. So, what really stands out here is who the market is rewarding and who it's not.
Right. To set the stage, markets closed mixed this week after a wave of AI-related headlines and a batch of company-specific notes. The big picture? Some names are priced like perpetual winners, and a larger group is trading as if the story still needs to be proven. Let's walk through the notable write-ups quickly. I'll start with a smaller name, Globant. Price was about $30.74, with a price-to-earnings ratio near 12.15. Analysts called it neutral.
Globant's interesting. They've had a sharp pullback over the last year, which dropped their multiples. Management says their AI annual recurring revenue pipeline is expanding, and AI bookings are picking up. But the note stresses conversion risk. Bookings don't automatically become revenue or margin.
Exactly. The research flagged pipeline metrics, AI bookings, and ARR expansion as the leading indicators to watch. So the story is compelling, but execution and client concentration are real risks for a smaller name.
Short reaction. Right.
Next up, Splunk. The write-up took a different tack. It's a data availability problem. The price referenced was around $156.90, but analysts noted that key financials were missing or labeled unavailable.
So their conclusion was basically, we can't make a reliable valuation without proper disclosures. Treat the price as preliminary and wait for SEC filings or company releases. That's a very conservative, method-driven stance.
For Splunk, the research emphasized information risk. When balance sheet or revenue data are opaque, valuation inference becomes noisy.
Okay, pivoting to identity. Okta. Price around $117.84, with a price-to-earnings ratio about 82.9. Analysts were neutral here too.
The case for Okta is persistent corporate demand for identity and zero-trust solutions. It beat on earnings and technical momentum looked solid. But with a price-to-earnings ratio that stretched, the upside depends on continued revenue growth and margin improvement.
Totally. Growth is there, but the valuation is pricing perfection. So any hiccup could matter a lot.
Twilio got attention as well. Price was about $186.20. Analysts were constructive but valuation sensitive. They noted accelerating revenue and strong interest in AI-enabled communications products.
And free cash flow was highlighted as a support, right? If Twilio can improve average revenue per user and retention, margins could expand. But multiples still looked rich in the note.
Yes, product monetization metrics, ARPU, and free cash flow conversion were cited as keys to justify higher multiples for Twilio.
Bill.com, the payment SaaS name, was priced around $32.48, with a forward price-to-earnings ratio near 10.05. That one was framed as growth versus risk.
They've scaled revenue and built cash reserves, growing payments and accounts payable automation. Forward multiples look reasonable, but trading near year lows and uneven profitability raise execution risk. Cash reserves and FCF were central data points there.
DocuSign intrigued me. Price about $43.49. Price-to-earnings ratio roughly 26.33. The note was neutral, but they emphasized renewed product momentum through AI integrations.
DocuSign is integrating AI across the product, including Slack and ChatGPT integrations, and it's reporting positive earnings per share, healthy return on equity, and low leverage. Yet the stock was near its 52-week low. That disconnect is a neat research question.
Short reaction. Interesting.
In medical devices, Intuitive Surgical was flagged. Price around $406.78, with a mixed stance. They remain dominant in surgical robotics with recurring consumables.
But growth has moderated since the post-pandemic rebounds, and regulatory scrutiny has increased. That adds volatility. Analysts said keep an eye on system placements and consumable attach rates.
Danaher was another note. price about $177.17. Price to earnings ratio near 33.99. The theme? M&A momentum meets valuation watch.
They're integrating big deals, like Massimo, reshaping life science exposure. M&A expands the addressable market, but integration and margin risks could offset some of the upside. Cash flow and inorganic growth contribution were the things analysts homed in on.
On the big secular names, Tesla was discussed at roughly $400.49, with a mixed stance. The note reminded us Tesla sits at the heart of the EV megatrend and has scale advantages, but return metrics are modest versus a roughly $1.5 trillion market cap.
And long-dated initiatives like Optimus and Robotaxi carry timing and execution risk. The consensus view is that the stock prices in a lot of future margin and product delivery.
Eli Lilly came up, price about $1,098.57, with the trailing price-to-earnings ratio near 40.93. Benefits from Mounjaro-driven revenue and acquisitions, but pricing and competition in obesity and diabetes care were flagged as pressures.
Which brings us to NVIDIA, the top AI compute beneficiary. Price around $210.69, and analysts were broadly bullish.
And this stat really jumped out. Return on equity clocked in at just over 111%. That's an extreme number, and it explains why analysts see NVIDIA as the primary beneficiary of AI compute demand. Cloud CapEx tailwinds and persistent GPU pricing power were central to their case.
Yeah, that ROE stat got a lot of attention. It's the sort of number that makes analysts collectively lean bullish. But everyone also noted valuation leaves little room for disappointment.
Which leads us to the cross-cutting patterns. First, AI is the dominant economy-wide growth vector. About half the coverage explicitly cited AI bookings, AI-enabled product demand, or cloud CapEx as a central driver. Think NVIDIA, Twilio, DocuSign, Globant, and implicit themes in Okta and Danaher.
Right, and the repeated push was, bookings are great, but conversion matters. Bookings to ARR, ARR to revenue, those conversion ratios are the early signals.
Second, valuation dispersion is huge, a two-speed market. On one extreme, you've got companies priced for hypergrowth like NVIDIA and Lilly. On the other, names like Globant and Bill.com trade at reset multiples that reflect execution risk.
Third, margin sustainability and monetization kept coming up. TWLO, Docu, Okta, and Glob Notes all said, show us margin expansion or ARPU growth, or the multiple is hard to justify.
Fourth, execution and regulatory risk matter, especially for industrial and medtech names. Danaher and Intuitive Surgical have M&A or regulatory timelines that can shift near-term outcomes.
And fifth, data quality. Splunk's note was a methodological reminder. Incomplete disclosures make valuation guesses unreliable.
Short reaction.
Yeah, that tracks.
There were a couple of contrarian takes worth calling out. One was Globant framed as an earnings yield way to get AI exposure if that ARR pipeline converts. It's a smaller, volatile name trading at a lower multiple. That's a different angle from chasing large-cap winners.
DocuSign was another. Analysts noted renewed profitability and AI integration, yet the stock was near its 52-week low. That dislocation between fundamentals and price is interesting.
And Splunk's approach was contrarian in style. Treat it as a data quality problem rather than trying to stretch for a target price.
So, method matters here. The research leaned on multiples, return metrics, ARR and bookings, and free cash flow as the main lenses.
Specifically, the team used price-to-earnings ratios, trailing and forward, return on equity, and PEG-like logic to relate growth expectations to price. They also emphasized ARR, bookings, and conversion rates for AI-related stories. Free cash flow and cash reserves showed up repeatedly as resilience indicators.
For hardware-heavy franchises, installed base and consumables were treated as durable revenue anchors. So, Intuitive Surgical and Danaher are really judged on installed base growth and accessory revenue.
And where data is missing, analysts called for patience. The Splunk note explicitly recommended waiting for SEC filings or investor decks before making valuation calls.
Okay, practical implications. What did the research suggest people should monitor?
First, monitor conversion metrics for AI narratives. For software and services leaning on AI, sequential improvements in ARR growth and margin expansion will be the market's proof points.
Second, Watch valuation sensitivity in high multiple names. In companies with stretched multiples like Okta, Nvidia, Lilly, and Tesla, small misses in guidance or margins can have outsized effects.
Third, use cash flow metrics to separate names that can weather volatility. Bill.com and Twilio underscore how cash reserves and free cash flow matter when growth wobbles.
Fourth, treat incomplete data as a material risk. Splunk again. Don't overinterpret price movements when core financials are opaque.
Fifth, for industrial and life science M&A, quantify integration and regulatory timelines. Danaher and Intuitive Surgical both showed how these factors can affect margins and ROE over several quarters.
Short reaction. Got it.
The research team also laid out a short research agenda for next week. Number 1, prioritize corporate disclosures in second quarter earnings that will update ARR and AI booking metrics. Specific names to watch include Nvidia, Tesla, and Intuitive Surgical, plus the SaaS players as they report.
Number 2, standardize ARR and booking conversion stats across software firms to compare conversion efficiency.
Number 3, track cloud CapEx indicators and hyperscaler commentary. That's essential for refining Nvidia demand assumptions.
4, monitor M&A integration KPIs for Danaher and Lilly. Things like cost synergies, revenue retention, and margin accretion.
5, watch regulatory and clinical updates for Intuitive Surgical. Any FDA or equivalent announcements could materially change risk premia.
6, clarify Splunk's data gaps. Prioritize any SEC filings or investor presentations that resolve the opacity.
And 7, track sentiment and technical indicators for high multiple names. Good to know liquidity and potential volatility amplifiers around earnings.
So, wrapping this up, what are our key takeaways?
First takeaway, AI is pervasive and real as a demand driver, but the market only rewards demonstrable monetization. Bookings are one thing. Conversion to ARR, revenue, and sustained margin expansion is what matters.
Second, the market is bifurcated. Some companies are priced for long-term perfection. Others are priced for skepticism. That creates very different risk profiles, even within the same AI narrative.
Third, cash flow and execution timelines are critical. Free cash flow, installed base monetization, and integration timelines are the concrete metrics that will validate or invalidate a lot of the optimism.
Fourth, be disciplined about data. When key filings are missing, treat price signals as noisy and wait for clarity.
Final thought, analysts mostly stayed neutral across a lot of coverage. Not because the stories aren't compelling, but because outcomes are conditional. That's a market built on scenarios.
And to repeat our standard reminder, this episode is for informational purposes only. Analysts note evolving data and scenario-dependent outcomes. This is not a recommendation to buy, sell, or hold any security, nor is it personalized investment advice.
Clear takeaway bullet points. Monitor AI booking conversion. Watch execution in high multiple names. Value cash generation. And wait for clear disclosures where data is opaque.
If you want to dive deeper into any of these names or metrics, head to stockalpha.ai and check the full research notes. And remember, if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening to Alpha Recap. We'll be back next week after the close to walk through the earnings cadence and any fresh disclosures. Take care.